Wall Street didn't walk away from the housing market. They just changed their playbook. As you may know, they've pulled back significantly on buying existing homes, but instead they're building entire neighborhoods. In fact, in 2024 alone, institutional investors built 39,000 new homes, but not to sell, just to rent, including over 3,200 homes right here in Central Ohio. Today, I'm walking through Stillwell at Jerome Village. This is a brand new build-to-rent community just outside of Columbus, Ohio. And this is a growing trend we're seeing with institutional investors. And it could reshape how we live, how we rent, how we buy, and certainly how we invest. Comment below, do you think build-to-rent is good for the housing market? Maybe you live in a build-to-rent community, but comment below, I want to know. So why are investors shifting to build to rent from buying existing homes? And why are they choosing cities like Columbus, Ohio to do it in? And what does it mean for the future of home buying? Let's take a walk. I'll break it down as we go. To give us an understanding of what's going on with the build to rent model, we're going to use an article from, you guessed it, Resi Club Analytics. And folks, if you're not already subscribed to Resi Club, I'm not sure what you're up to. If you care about the housing market, you owe it to yourself to subscribe to Resi Club. They have the best real estate data. They have a free newsletter that they put out every week. And they also have a paid subscription that I have access to. Hey, if you're new to my channel, welcome. My name is Jason Ferrier. I am the housing nerd. I've been a realtor and investor in Central Ohio for the past 7.5 years. So first, we're gonna take a look at the history of build-to-rent communities and kind of how they all got started. According to the Resi Club article, institutional funds buying at the bottom of the housing crash from 2011 to 2013 marked the birth of the modern institutional single-family rental asset class. But as time went on and home prices bounced off the bottom, acquisitions weren't as lucrative. To improve margins and streamline operations, single-family rental operators began purchasing scatter site homes near the properties they originally bought at the foreclosure auctions. By around 2016, many institutional investors realized they could achieve better returns by partnering directly with home builders to develop dedicated single-family rental communities, like the one behind me. That's a strategy called build to rent. In fact, according to this article, American Homes for Rent, that's actually owned by Blackstone, maybe you didn't know that, but they are, they went a step further and actually created their own construction in-house division to build properties just like the one I'm at today. But then, at the onset of the pandemic housing boom in 2020, institutional capital saw yet another window of opportunity. National home prices and rents were surging, and you know as well as I do that they were, right? Like in 2020, home prices went absolutely parabolic, so did rents. And why is that? Well, borrowing costs were super low and capital markets were flush with cash. So before monetary tightening took place, before the Fed started raising interest rates like they did in 2022, these big institutional investors piled in to not only acquiring single-family houses, but obviously building sites just like this. Now, if you can do me a favor, subscribe to The Housing Nerd if you got any value out of this video. Hit the like button. I greatly appreciate it. And share the video with somebody that you think would enjoy it. So to help us really understand this build-to-rent model, Resi Club gave us 11 key takeaways from their article. That's what we're going to review right now. Over the past decade, the single-family build-to-rent model has rapidly evolved from a niche investment strategy into a full-blown asset class, fueled by institutional capital and consumer demand for a rental product that isn't multifamily. So what makes build-to-rent different from like multifamily? A lot of people ask that. Well, the fact is that these are single-family houses. They're detached houses, most of them anyway. Some of them are duplexes, but they're not big, massive apartment buildings. So they're giving somebody kind of like a house to rent versus an apartment to rent. And you can see pictures of them right now on the screen. You can see what they look like kind of inside and kind of some pictures from the website. These purpose-built rental neighborhoods cater to renters seeking the space and the privacy of a detached home while not having to buy, but instead they can rent. During the pandemic housing boom, a period of ultra low interest rates, money flush capital markets, and soaring house prices and rents, build to rent investment soared. While build to rent investment has pulled back from its peak, institutional capital and family office money are still looking to deploy into build to rent. In fact, according to one of the CEOs from one of these build to rent institutional investors, he says, when the single family market started in 2011, it was just a momentum trade. You could buy homes on courthouse steps for $10,000 to $15,000 each. Put in double that on renovations into the home and maybe sell it for double you put in. But then the market evolved from a fix and flip, and this is important, folks, to fix and rent. They started to see that people wanted to rent. And that's where it gets crowded because they had competition from KKR and Blackstone, huge institutional buyers. And buying individual houses in different neighborhoods got quite expensive. And so they said, hey, there's home builders building homes that people want to live in. Let's just go directly to them, have them build us some communities, and then we don't have our individual single family houses scattered across the county or across the state, even across the country. And this CEO points out the home builders don't care who actually, buys the home, if they're going to be somebody that's going to rent it out or there's going to be somebody to live in it and buy it and call it their own. They don't care either way. So these investors come in, go to the home builders and say, hey, build us a bunch of these single family detached homes or these little duplexes. We're going to rent them out. And the home builder's like, sure, we'll do it. So the biggest concentration of this build to rent model is really in the Sun Belt states, right? Florida, Texas, out to Phoenix. However, we are seeing a growth in build to rent in the Midwest, areas like Ohio, obviously, Indiana, even in the Northeast somewhat. But as you can see from the map, the biggest concentration is in the Sun Belt states. And the article goes on, the Sun Belt has been the epicenter of single-family build-to-rent. For a while now, a combination of demographic tailwinds, favorable economics, a developer-friendly policy has positioned the region as ground zero for this asset class. First, population growth in many pockets of the Sun Belt states have been relentless. Many of these new residents are families or retirees who prefer the space and privacy of a single family home, but they aren't ready or able to buy. There's a tagline out there, kind of a slogan that says, you'll own nothing and be happy. And that's what these institutional investors are trying to take advantage of. They're saying, hey, there's a lot of people that are priced out of the housing market. They can't afford to buy a house, but they can't afford the $1,500, $2,000, $2,300, $2,500 rents. So we'll go ahead and build some new houses that they're going to want to rent. And the cost for the developer, the cost for the institutional investor comes down significantly. Why? Because everything's right here in this community. They don't have to drive all over creation, just to service their, the homes they buy. The second reason why build to rent is so popular in the Sun Belt states is that land in many of the Sun Belt states, it's generally more available and it's more affordable than in dense urban U.S. coastal markets. I mean, land here in central Ohio, it's everywhere. There's tons of room to build here. Like they haven't even scratched the surface in central Ohio as far as how much building they can do. Not only with places like this, but just homes, apartment buildings. I'm gonna walk out here in a minute and show you some of the land around this area, and it's just open farmland, basically. I mean, this community really popped up in the middle of like complete open space. The third reason they're focused on the Sun Belt states is that local governments in the region tend to have more favorable zoning laws and fewer regulatory barriers, allowing for quick project approvals and smoother execution. Fourth, it's also where single-family home builders already have the biggest presence, giving build-to-rent developers access to experienced local partners and supply chains. So we know already, if you're paying attention to the housing market, you know that home construction of homes to buy, actually for people to purchase, has exploded in the last year. We're actually near 2009 levels right now, like around the GFC type level of finished unsold homes, new homes that are on the market. And many of those homes are in the Sun Belt states. These institutional investors are like, hey, that's where we want to do these projects, areas where home building is still taking off. And there are quite a bit of new home projects here in central Ohio, so it makes sense we're seeing build to rent here as well. Here's probably the biggest reason they picked the Sun Belt states. The math worked. Got to have the math working. Sun Belt operators could underwrite stronger rent growth and more favorable yields, making the region especially attractive to institutional investors and family offices looking to deploy capital into build to rent. And sixth, many Sunbelt markets already had robust single-family rental ecosystem thanks to the institutional scatter site acquisitions that followed the 2008 housing crash. When they say scatter site institutional investing, what they mean is basically going around a market and buying individual existing single-family homes. You know, one on this block, one on that block, one on this neighborhood, one on that neighborhood. And again, that's a lot harder to service if you have a lot of them versus, you know, houses that are just right next to each other and you own the whole community. So look at this graph now from Resi Club. This is the 40 metro area housing markets with the largest recent footprint of single-family build-to-rent homes. And so Phoenix, number one, right? Dallas, Fort Worth, number two. Atlanta, number three. Houston, number four. Charlotte, number five. Austin, number six. And the list goes on, right? A lot of sunny, you know, Sunbelt states, like they said at the beginning of the article. But then you get to some other areas that aren't so, you know, predictable, like Columbus, Ohio, and Kansas City, and even Nashville. So if your metro's on this list, I would expect to see more and more build-to-rent communities popping up near you. Back to the article. Markets like Phoenix and Atlanta were major hubs for institutional single-family rental investment following the 2008 crash. Firms like Invitation Homes, Progressive Residential, and American Homes for Rent built sizable portfolios in these metros by acquiring distressed properties, right? After the 2008 crash, it was easy to pick up a home for, you know, $15,000, $20,000, $30,000. Last night on my live stream, we looked at where some of these markets were priced during the 2008 housing crash, and it is absolutely crazy. Like if you look back during the 2008 to 2012 housing market, the houses were a fraction, obviously, of the cost that they are now. So these huge buyers came in with buckets of money and just swooped up these distressed properties. Many of them probably weren't that distressed. And let's face it, most institutional investors don't buy like houses that need complete redos. They want something that's pretty easy to turn around and, you know, put a tenant into. And basically the article's saying, hey, they already had a presence in these markets because of the distressed buying after the GFC. So now, no big deal to ramp up and build some build-to-rent communities. So the next section of this article talks about why they're picking the markets they're picking. They kind of expand on that. A lot of it has to do with population growth. So if you look at the chart there on the screen, you can see, for instance, Phoenix, Arizona. If you look at the y-axis, that is the amount or the percentage of build-to-rent units per 1,000 rentals. So basically in Phoenix, for every 1,000 single-family home rentals, they've got 40 build-to-rent models that they've already built. And then the x-axis at the bottom shows you the population growth because they want to focus on areas with population growth. I mean, right there near the top of the list, folks, is Myrtle Beach, South Carolina. They've got a massive amount of population growth projected, and their build-to-rent footprint is pretty large. Why is that? Well, a lot of retirees go there, obviously, and you know, it's kind of an easy, quick drive to many areas on the eastern seaboard. So it makes sense for these guys to invest there and pop up these communities. This next part, though, is somewhat confusing for me. Like, this is where I think these build-to-rent models may struggle in the near future. The build-to-rent pipeline is largest in many of the nation's softest rental markets in 2025. And that graph on the screen, the majority of the recent single-family build-to-rent supply is in markets where rent growth in 2025 is softer than the national average. And they say, as Resi Club is closely documented, many of the softest housing markets in 2025 were in the Sunbelt states, the very region that these build-to-rent operators have been piling into. And they say, and this is what I agree with Resi Club here, while the greater softness in the Sunbelt, particularly in Texas, Florida, and Arizona, won't last forever, given the region's underlying demographic and growth fundamentals, in the short term, slower rent growth has affected deal underwriting and has temporarily caused some capital to look at other asset classes. So they're saying basically, you know, because rents are softening in many of these Sunbelt areas because of an explosion of multifamily building going on, that, you know, a lot of these build-to-rent deals right now in the Sunbelt areas are getting squashed because the numbers aren't working anymore because they banked on larger rents. Another reason why it's a little confusing why they're loading into these Sunbelt markets is that those markets are where home price growth has slowed the most. At the end of April 2025, total U.S. active housing inventory for sale was still 16% below pre-pandemic levels. Generally speaking, markets where inventory has returned to pre-pandemic levels is where we're seeing the most price softening. And a lot of that is in the South. Conversely, housing markets where inventory remains far below pre-pandemic 2019 levels have, generally speaking, experienced more resilient home prices in the last couple years. Again, this is curious to me why they're picking these markets. A noticeable amount of single family build to rent supply that has come online recently and is in the pipeline is located in those softer resale markets where total active housing inventory for sale is above those pre-pandemic levels. Indeed, 59% of the recent single family build to rent footprint, including deliveries over the past 5 years plus the current pipeline, is located in metro area housing markets that are currently above pre-pandemic 2019 levels. That's a big amount. When just looking at the current pipeline, that figure is still 59%. So it's the bulk of the single build to rent single family developments are in markets where maybe they're not as needed, I guess. Given that build to rent isn't intended for a resale market, why does it matter that a sizable chunk of build to rent supply is coming online into the current softer, weaker resale market? Good question. Let's find out. They say to some degree it matters because home price appreciation can factor into build to rent underwriting, obviously, although it's typically a secondary consideration compared to rental yield and cash flow. So they're saying, hey, just because the resale market is soft in a particular area doesn't mean the rental is soft in a particular area. And here's where I think their play is, if you really think about it. If you look at home prices in this general area we're in now, they're in the neighborhood, median price is in the neighborhood of $450,000 to $500,000. Now, the rents in this community, as you can see on your screen right now, start at $1,500. Now, they do go up from there to the mid-2000 range, but that's far below what you would pay if you tried to buy a house in this area. And that's, I think, is where they're targeting. That's why they're going after building these type of communities. Because one of the big factors is property taxes. And if you rent a place like this, you don't have to worry about it. But if you buy a house over here, I can guarantee you, especially a new build, your property taxes are gonna go up exponentially, especially after you move in. I mean, there's horror story after horror story of folks getting completely hornswoggled when they discover that the original property tax quote that they got is far under what they're actually going to pay once the house is built. So they are predicting, though, that this build to rent model is going to roll over as far as the amount of growth that we're seeing. In other words, it's going to taper off somewhat over the next couple years. To further illustrate the build to rent model versus buying a home, meaning if you were someone who was looking to buy a home in this area and you were trying to decide between renting one of those single family houses that we just saw versus buying a home in similar size, I came over to this other development that's right next door because there's a home for sale right now, 2-bed, 2-bath, 1,769 square feet. You can see it on your screen right now. I'm gonna get out of the car real quick and show you. There's a bunch of people around. I've already gotten yelled at once, but let me show this to you. Tell me what you think of this. So that house right there is priced right now at $583,020. I mean, they had to put the $20 in there, right? But it's 1,769 square feet, 2-bedroom, 2-bath. It's a brand new build, nice house. Now they say the estimated payment is $3,117, but that's not the real payment because that payment is fake. When you scroll down and you actually look at how much it costs to buy it monthly with property taxes, insurance, and an HOA fee of a whopping $275 a month, the total payment is $4,060. Now, how much is the build to rent community if you're looking for a similar size property? Well, their biggest model over there is a 3-bedroom, 2-bath, so it has an extra bedroom. It is smaller at 1,279 square feet, but the price, $2,500 a month. And that's all in. So that includes, basically all your maintenance, all your insurance, all your taxes. I mean, you have renter's insurance, I guess, but that's like nothing a month. It's like $50 a month, $30 a month. So you can see why investors are piling into a build to rent community when they know that somebody who wants to live in this area of Columbus and wants a smaller house, a 1,700 square foot house, they're gonna pay $583,000 for it and over $4,000 a month. And you're living on top of other people and in a construction zone for the next, whatever, decade, because there's tons of property around here to keep building. So it's easy to see why that build to rent model makes sense. Okay, I'm gonna go back to the build to rent community to finish out the video. According to Yardi, single family build to rent deliveries are projected to decline in the coming years as the pipeline, supercharged by the easy money pandemic housing boom, continues to wind down. In the long term, Brad Hunter, president of Hunter Housing Economics, tells Resi Club he expects build to rent to make up a larger share of total housing starts. After all, just look at JP Morgan Asset Management when they said that they would team up with Georgia Capital and Perron Homes to establish a single family build to rent company named Laster. Georgia Capital and Perron Homes to establish a single family build to rent company named Lasseter. However, in the short term, he agrees directionally that build to rent completions are set to decline from their 2023 to 2024 highs due to the shift in capital markets following the interest rate spike in 2022. Many of those peak year completions were launched before the capital landscape changed. So basically, when money was cheap, they launched all these projects, probably got them financed at a very low interest rate. Now that interest rates are much higher, developers, institutional investors are like, nah, maybe it doesn't make as much sense right now, but you can better believe if interest rates drop and they have access to cheap money again, they will continue to build these type of communities. I mean, honestly, it just makes sense if you're one of the institutional buyers, like why not? If your money is basically free or if they drop interest rates just by a few percentage points, it can make a massive difference. Okay, now we're gonna hit on again in a little more detail about the rent versus buy argument that a lot of these build to rent developers and investors have. Basically saying it's cheaper to rent one of these things than it is buy in the current market. So this chart I thought was one of the best ones from the article. It basically shows you a metro area, then shows you a typical single family home price, right? So if I scroll down and look, I've got Columbus, Ohio at $347,000 approximately, which in this particular area I'm in now would not buy you a Cracker Jack box. And the payment on that is $2,060. But guess what? They're not including property taxes and insurance. So that $2,060 payment would probably be more like $2,800 to $3,100. And that's just for a $347,000 house. If I'm after a house in this particular area and school district, that payment's easily over $3,000, probably approaching $4,000 a month. Now the next column there is the typical single family home rent. And you can see in Columbus, $1,967. The difference, $93. So in their particular example here, they're saying basically you're gonna save 93 bucks a month if you rent a home versus buy a place. Well, in this community, if you want to pay $2,000, $2,500 bucks a month, you can get a pretty nice model in here and not have to worry about property taxes and insurance or maintenance either, right? You don't have to worry about maintenance. These guys take care of it for you. Back to the article, they say over the past year, Resi Club has interviewed numerous build-to-rent developers and operators, and almost every single one of them has pointed out to the buy versus rent math as the reason they're bullish on single-family build-to-rent sector long-term. Are they right? Our quick and dirty analysis above in that graph, which simply compares the typical monthly single-family rent to the monthly principal and interest payment on a typical single-family home today, shows that many home buyers in today's market are absorbing monthly payments well above what they'd pay in rent. That gap has widened significantly since mortgage rates spiked in 2022. And look, you may not want to hear this, but this is why these investors want rentals. This is why I have rentals. This is why I continually look for opportunities to buy rental properties, because I know that people want to rent when they can't afford to buy. I mean, forget the convenience end of things, just the sheer fact of numbers, right? Now, I don't own anything near this nice. I wish I did, but I don't. My stuff's a lot more, moderately priced, we'll say. But the numbers make sense, right? I mean, there's a lot of tenants I have that are like, shoot, I can't afford to buy in this current market. Even in small towns in Ohio, they can't afford it, even though they'd like to. So what do they have to do? They have to rent. And I don't take inventory off the street that's move-in ready. I take homes off the street that are beat up, destroyed, and they're all old. Like we're talking 1910, 1915. So I'm revitalizing these homes and these neighborhoods and putting people in them that need a place to live at a reasonable rent. And he goes on to say, while this buy versus rent analysis isn't close to comprehensive, it does not factor in variables like taxes, insurance, and maintenance. And speaking of taxes, I actually did a great video on property taxes in Ohio and how we may actually get rid of them completely. It's received over 100,000 views. It's right here if you want to check it out in your spare time. But let's keep going. So while this buy to rent analysis isn't close to comprehensive, it doesn't factor in variables like taxes, insurance, and maintenance, long-term home equity gains, opportunity costs, or the possibility of future refinance, it does highlight the immediate affordability pinch keeping some home buyers on the sidelines. Comment below. Are you renting now versus buying on the sidelines because houses are just too darn expensive? And I'd love to know if you live in a build-to-rent community. Do you live in something like this? Do you like it? I'd also like to know, would you move into a place like this if you don't live there already? Is this an option you would explore if you needed a place to live? So Resi Club's saying that they're not totally bought into the bullish narrative that build to rent is the thing of the future because of that gap in buying versus renting. However, they do admit that it gets more compelling when you also account for the secular shift of Americans pushing out adulthood milestones, which for some means renting longer into their 30s, and a period when some will begin to prefer single-family houses or townhomes over traditional multifamily products. And this next graph actually goes into the size of these build-to-rent communities, the size of the units, because they're actually getting bigger, which is completely different than build to sell, not build to rent. But the houses that a lot of builders are building to actually resell to people, to homeowners to live in, those are getting smaller because houses are so darn expensive to build and to buy, so they're trying to make those smaller. But build to rent, they're actually making them bigger. After steadily rising for decades, the median square footage of a new single-family home peaked around 2015 and has gradually declined since. Ironically, while for-sale homes have been getting smaller, single-family homes built for rent have been getting larger. This divergence reflects the differing customer bases and economics of each segment. Since 2015, for-sale builders have responded to, one, the lack of entry-level home building in 2009 through 2015, following the housing bust, was particularly hard on lower end of the market. Post-2022 affordability constraints, shrinking floor plans has been one way home builders have met the budgets of many first-time buyers. In contrast, they're saying, build-to-rent communities have been getting bigger with their units because they want to cater to not necessarily an 18-year-old who just moved out of their house, but they're wanting to cater to the 30 to 40-year-old who maybe even has a family, kids, dog, whatever, and wants a single-family house but can't afford it or simply doesn't want to afford it. And guess what? In one of the units I own, and I've shown a couple on my channel that I own, like, I don't really have that many amenities. Like, it's just basically, you know, an apartment or a duplex. I own a few single-family houses, but mainly just like duplexes, triplexes, and quads. And I don't really have that many amenities. Like, a couple of them I have garages. I've got some outside water spigots, you know, but that's really not my bag. I'm not trying to build the nicest place in the world because I'm trying to keep rents low. But in a community like this, when you got garages, you know, you've got little backyards in this one, although they're not huge yards by any means. You've got some privacy. And they're not in big multifamily buildings, and they're brand new, more of a single family house feel or patio home, you can charge a heck of a lot more in rent, and that's what's attracting the investors. The next section of the article goes into how many institutional investors have pulled back from the scatter site home building, right? It's important you know that term, scatter site, meaning different areas, you know, not all in one community. They pulled back there, but many of them are still piling into the build to rent. And they say, look no further than American Homes for Rent, which has gone all in on one build to rent and developed its own in-house home builder. According to the latest Builder 100 ranking, American Homes for Rent is the 37th largest American home builder, and they're building build for rent only, not build to buy. In Q1 of 2022, American Homes for Rent acquired, and that's Blackstone, just in case you don't know, they acquired 931 homes, with 325 coming online from its in-house home builder, meaning build to rent accounted for 35% of its Q1 2021 acquisitions. In Q1 of 2025, American Homes for Rent added 437 homes, with 424 coming from build to rent. So what does all this build to rent hoopla mean if you're a buyer, seller, or investor in real estate? I would consider three things. Number one, build to rent is shrinking buyer access to ownership. Build to rent builders are not building to sell, they're building to rent, and they're stockpiling these rentals. Well, if you're a buyer, what does that mean? It means that these institutional investors, as they build more of these type of communities, and home builders are building more build to rent, that's going to shrink the supply, and that's going to probably frustrate a lot of home buyers like here in Columbus. I mean, Columbus doesn't build that many homes to begin with, ironically. We have some development, but not a ton. And so to see a development like this, you're like, wow, I mean, they're building these to rent. It'd be nice if they built small ones to buy, but obviously not economically feasible for some reason. So the first thing to know is that this type of activity could make buying a starter home even more difficult. Because they're doing more build to rent, that means institutional investors may not pay attention as much to single family houses that are scattered throughout an area as much as they did back during, the 2008 through all the way through this latest COVID era, where they were just buying hand over fist. Now, I'm not saying they stopped altogether, but if they dial back that type of acquisition of scatter site home buying, it could free up some starter home inventory in the future. At least that's my thought, but you comment below and tell me what you think. Now, if you're trying to sell in one of these markets where there's a lot of build to rent, this is your competition. If you have a nice little starter home, even a mid-size home, and you're not priced correctly, you could be competing with a development like this where a potential buyer's like, no thanks, I don't want your house, I'm not gonna pay that price. Instead, I'm just gonna rent. Because let's face it, build to rent, it comes with fresh finishes, it comes with new interiors, it comes with amenities like, I'm sure they have a pool. I saw a pool up there. They obviously have like a little workout area, which I don't know if that's a whole lot of value. Those gyms in these places usually completely stink. But at the end of the day, they have amenities and it's maintenance free. So if I'm a buyer out there and I'm looking for a house to buy, a small one, and I go to your house and I go, well, that's, $450,000 plus taxes and insurance and maintenance. I don't think so. I can just come to one of these communities, move in, call it a good day. So really, sellers, if you're selling a house where there's a lot of build to rent, you got to step up your game. Now, number 3 is a warning shot for somebody like me. Small investors. Build to rent operators have Wall Street money, bulk pricing, and pro-level experience. But me, I've got a couple rentals and a handyman or a property manager on speed dial. And sometimes, like you've seen in my videos, I actually go out and fix the stuff myself. So me competing with a build to rent developer like American Homes for Rent, that ain't gonna happen. So these guys are building entire communities and I'm trying to cash flow off a triplex built in 1910. So it means for me, I have to niche up. I have to get really granular and strategic on where I'm buying my properties. It would take a huge discount for me to buy a property in this area as a rental. Why? Well, I've got these competitors here. There's new apartment buildings going up around the corner. I mean, it's gonna be very difficult to compete unless I buy the house at an insanely low price. And we all know right now that's tough to find. So I like to target areas for my rentals that are underserved. Like where I'm buying right now, people aren't gonna build to rent communities there. And the price points I'm charging are not astronomical. So it wouldn't make any sense for a build to rent operator to come into the neighborhoods I'm investing in and set up shop. Now I happen to just have a conversation with someone who lives in this community and they had great things to say about it. They said that the units were really nice. They live in one of the 1-bedroom units and it rents for $1,500 a month. But she said her trash, her cable, all the maintenance, all the yard work, all of that is included obviously in the rent. And it's all one level. And she said she's having knee surgery, so doesn't have to worry about, going up and down stairs. And she absolutely loves the community. They have a heated pool. So, there's one resident who enjoys it, and I'm sure there are many more. But comment below, would you live in a community like this? I'd like to know. Now, I did another video about Wall Street institutional investors in the housing market, and you can check that video out right here.